Hello, my name is Michele, and you're listening to Profit is a Choice.
On the podcast today is Keith Knapp. Keith is a nationally recognized speaker and educator in business, marketing, and credit. We're going to focus our conversation today on business credit. We're going to define what it is, why you need it, how to get it, and how to keep it. This is a very interesting and timely discussion. I know I sure learned a lot and had my eyes open to a few things, and I hope you do too. Enjoy the podcast.
Every day, empowered entrepreneurs are taking ownership of their company financial health and enjoying the rewards of reduced stress and more creativity. With my background as a financial software developer, owner of multiple businesses in the interior design industry, educator, and speaker, I coach women in the interior design industry to increase their profits, regain ownership of their bottom line, and to have fun again in their business. Welcome to Profit is a Choice.
Hey, Keith, welcome to the podcast.
Thanks, Michele. I'm glad to be here.
I am too. You know, I was looking through some of the information that you sent prior to our conversation and digging in a little bit about some of the offers and the things that you do. And I'm telling you, I am so excited simply because, you know, where we are right now, business credit, which is what we're going to talk about today, is something that we all really need to be aware of. For some of us, our credit may have taken a hit during COVID and some of the business disruption that created. And for others, it might be that their business credit went sky high, that they did a really great job of managing it. I do profit first, and so I teach my clients all the time how to save money and how to prepare. But wow, this has been quite the roller coaster, hasn't it? This isn't something that, I mean, even with a 3-month preparation, it hasn't been enough for many.
Oh, yeah. And what we're finding, Michele, is that the business credit industry is something that's been hidden for a long time. And that's why Credit Suite has been so big about getting out in there. Is our passion is one thing. We love entrepreneurs. We love business owners, and we want to do everything within our power to help them succeed. Everything that's going on with pandemic, all the social stuff that's happening at this time, that's always going to come and go. I mean, you're always going to have events like that. And what we find is that entrepreneurs, we're kind of the most resilient people that are on the face of the planet. No matter what's thrown at us, we're always going to find a way to adapt to it, to overcome it, and to keep going. What we've really focused on is helping business owners to be able to separate their personal and their business assets. And that happens at the deepest level, including the credit. So our whole focus with our clients and with business owners as a whole is to be able to empower them so that they can separate their business and their personal credit, and they can start getting approved for funding and start getting lines of credit that's just in their EIN number. So it gives them that layer of security, that protection. So no matter what happens, whether it's COVID, whether it's Godzilla attacking or whatever happens,
Right,
that they're protected and their personal assets are not impacted by, necessarily devastated by what goes on with the business.
And it's so good to have those separated. I'm constantly begging the listeners not to commingle their funds. And maybe there's an opportunity here. We don't really want to have our credit so commingled that personally we're devastated when something happens. Can you start by just explaining what business credit is and why we need it?
Oh, absolutely. That's a great question. Business credit is just like personal credit. It doesn't function the same way, but it's essentially your business, your EIN has a credit profile with the credit bureaus. Credit bureaus that we find are Equifax, Experian, and Dun & Bradstreet. Those are the 3 major credit bureaus. But just like on your personal credit, there's a lot of other bureaus that are out there that have access to it. And so what your personal credit is taking the information of who the business is, like the name, the entity type, how it's filed, how it's registered with the Secretary of State, how things are listed on the website, how it shows up on 411. All of that information is basically the identity of the business. And how that's portrayed online, how that's portrayed in the public, is how that's actually translated over into the business credit space. So what's happening is that you're forming this credit profile without you ever knowing it. Just like you personally, you may have things that are on your credit that you don't know about. On the business side, there's information that's being submitted about your company if you're getting lines of credit that report for business. And what we have found over the years is that businesses just don't even really know about it. I mean, it's just now starting to come into the forefront of the people's mind of understanding it. But for years, nobody even knew that businesses had credit reports and had scores. And this credit report and scores are directly tied to lending. So getting credit cards, getting loans, getting credit lines, SBA loans, all that stuff is tied specifically to the business credit profile. And that's basically in a nutshell what business credit is.
All right, I'm going to just dig in and make sure I understand what you said. So if we are working under an EIN in our business, and if under that EIN we have taken out, let's say, the PPP loan or an SBA loan or a credit card that we've paid off or anything, whether we are trying to build credit for our company or not, or whether we get those reports or whether we don't, it is still being created and captured by that EIN number the same way that it would be if we were using our social for our personal.
It's not being captured by the EIN number. Let's be clear about that. The EIN number that's a tax number. That's your employment identification number. You have to think of it this way. Credit's gotten popular in the past decade or so. But before that, credit was never made for consumers. And just the same way, business credit was never made for the actual business themselves. Business credit, personal credit, all credit reports, all credit scoring is made for banks. It's made for the lenders. It's a risk assessment is all it is. It's there to establish what the likelihood is of you defaulting on a loan if they give you money. And so what happens is that as you're applying for the PPP, as you're getting credit card, as you see, oh, look, I can get an Amazon business card, or these different accounts that you see as you're running your business, they're reporting it to the bureaus. And if you're using your EIN number, it's tied to that. Now, I think what you're asking, and this is one of the things that we find is one of the most critical mistakes that businesses are making. What happens is people are going out and they're applying for things, there's inconsistency in the data. So the way that the credit bureaus work is they're nothing more than aggregators. They're just going out and they're collecting all this data that's being thrown out. They've got banks that are sending them in, they got credit card companies, they've got lenders, and checking account. All this stuff is being thrown at them. People are putting the information into the bureaus. And then they're just taking it and then they're lumping it together based on the data that's submitted to them. And what we found is that because when you're starting a business, I mean, the first couple of years, it is volatile. But on top of being volatile, there's just a lot of changes because you may start in your bedroom and then you get a one-room office and then you start growing and you start building. So your business is constantly changing in that first 1 to 5 years. And as you're out there applying for things, your information may change. The EIN number may still stay the same, but the address may be different. The phone number may change, your website, your emails. And all that stuff contributes to how it's reporting on your business credit reports and what is actually showing up on your business.
Okay, so I can remember a couple of years ago, some of the data breaches that happened. And my husband and I, we automatically went in. And so I get monthly credit reports personally from Experian and Equifax and all the different ones, just to make sure, and we review to make sure everything on there is really ours. Kind of like you said, where the information can sometimes come in and be collected and aggregated. It's not always up to date. And sometimes it's not the right information.
Right.
And so we on the personal side, every month constantly reviewing our credit information to make sure that what has been captured was really ours. Okay. I have never done that for my business. So that, if I am understanding correctly, then there is out there information about my business and under my business name. I mean, I've been in business 20 years. I get the banks that send me these line of credits for these unheard of amounts and telling me I can get all this money. I shred them and throw them away because I don't want them.
Right.
But that means somebody somewhere is looking at my information to even reach out to offer me 10,000 credit cards for my business and all these lines of credit. So where should we be going? This is new to me to really think about my business credit. I've never had to take a huge business loan. My business was funded because I put money into it, right? As my husband lovingly calls himself, my angel investor all those years ago. And and I did. I paid back to my home. I paid the loan back. We put in. And that's probably, for a lot of my listeners in the interior design space, that's probably what many of them, if they are not taking out loans, Keith, for either a building, something like that, if they're more home-based or if they have had a slower growth progression. Many of them have invested their personal funds to get the business off the ground. So this may be new to them. Where do we go if we were just to say, I want to know just like what the baseline is, how do I find out what the credit score is or the credit information that has been attributed to my company?
Well, the quickest way is you can actually get access to credit monitoring through NAV. It'll aggregate all the data from Experian, Equifax, and Dun & Bradstreet.
Who is that through?
Well, you can actually get it through creditsuite.com/monitoring. We have a special discount link in there, but it's through NAV is who it is. NAV is the monitoring company that gives you
and we'll
access.
Put that in the show notes.
Yeah, absolutely.
Okay.
That's the first place to start. Now, the thing about it is that let's take the example of your startup company, or not even startup, or they're having kind of a slower progression, or let's be honest, they're making their money and they're happy and they're not really worried about growth and funding until stuff like this starts to happen and it starts to escalate the issue and push it. There's a lot of sources that are out there. Now, the public ones you can access through NAV. You can get it through the monitoring link that we'll have in the notes. But you can even just do searches through, like we have access to searches through LexisNexis that we'll go through and pull all the public records and all the public data to see how it's all reporting that way as well. There's a lot of different resources and a lot of different places that the information is being shared. And that's where like we're stepping in for people and we're looking at it and populating it all together in a report so that they can see exactly what's going on. But there's a lot of information that's being populated from several different locations. And like I said, NAV is one of the best places to start. But if you want to look at the individual reports, like you would on credit, it would be Experian, Equifax, and Dun & Bradstreet are the three major bureaus for business credit reporting.
Yeah, because it's always one of those things that I might want to build on it or do whatever. But I want to know, like, where do I stand? Especially for somebody like me, I've been in business 20 years. I want to know where I stand. I just have never needed to use that credit or go after that credit to have to even delve into it. Like I said, some of my listeners probably have and some have not. For some of us, this is a new thing. Let's say they're new, or even if they're advanced, how do they go out and just get business credit?
Great question. So, and one of the things that I always like to define when we're having this conversation is understanding that business credit and business funding are two different things.
Okay.
Because business credit is your credit reports. It's what's reporting on your credit, just like your personal credit isn't actually a thing. It's a credit report. It's a report of people that are loaning you money. And so to have a business credit report, you would have to have money that you're borrowing for your business. And you're borrowing it under your business name, under the EIN.
Okay.
Make sense?
Yeah. So a couple of different things. One is we probably need to be aware of, and correct me if I'm wrong, but one, we probably need to be aware of our business credit score. And the second thing is, if we have taken out some type of business credit, let's say right now, PPP, EIDL, the SBA loans that people are taking out and have during this time, if those are under the EIN, we should be able on a credit report, if those are outstanding or even if they're closed, maybe they should still be showing up if we put them out under our business. Is that?
Yes, that is correct. And when you start getting like having conversation about the business credit scores is something that gets even more in depth. So, I mean, as you can see, it's kind of like an onion. You start unwrapping it, you find more layers over as you go in. Let's talk about the scores for a second. So the interesting thing about business credit scores, like personal credit is based on a 7-year history. It's populating data for basically 7 to 10 years. And then the FICO scoring model is going in using their algorithm to calculate your scores based off that 7 to 10-year history. With business credits, it's ran through a company similar to FICO. It's called Paydex. So you're looking at your Paydex score. It's rating you from 0 to 100. It's a different scoring model, but it's also only judging you on a 12-month period because businesses aren't people. They function much differently. There's the money, the stability, the financials change very rapidly within a business opposed to statistically what you've seen on the personal side. So getting your business credit scores is important, but it's also good to know that your credit scores on the business side can change in a month, in 2 months, in a year. You can be in a completely different space than you are right now. So it's a lot faster pace to move with the business credit scores than it is with the personal. which makes it easier on some fronts to be able to get approved for funding and to get your business to a place where you're really fundable.
So it's pretty dynamic. It can go up quick and it can probably go down as quickly as it could go up.
Yeah, here's the thing. The majority of it's based on your payment history. So it's not looking at balances like on your personal credit. If you're like, I need to improve my scores, I'm going to go pay down my credit card. On your business credit, it's all about your payments, where you can have, let's say you've got one account reporting with Uline. If you're on a net 30 with them and you're paying them day 31, day 32, it's going to drop that paydex score. If you turn around in a month and you start paying it on day 20, day 22, now your scores are jumping way back up because your payment history looks great and you're paying it before the actual due date.
So even just changing that due date to be 1 or 2 days before it's due
can have much more of an impact on the business credit side.
Interesting. Okay. And when we say on the business credit side, we're talking about not only the score, but then the way that our credit is looked at. So then that can influence the type of funding or the amount of funding that we can get.
Very good. Yeah, see, I like talking with people who understand the concept of it. And this is going to bring us right back into the other question that you asked about establishing business credit. As you're making these payments, one thing that lenders are looking at is they're looking at what are called different tiers. Basically, there's about 4 tiers of building business credit. And what it's based off of is the ability to get credit. So tier 1 is, we're not going to call them bottom feeders. We're going to call them easy. It's mostly going to be like 22 accounts where you're not going out and you're going to get this huge line of credit, but you may go to quill.com and be able to get approved for a net 30 account that starts reporting. There's a lot of companies out there. So what we always recommend is if you're new, if you're just starting to build and establish your business credit, getting some places like Uline, Granger is another good one, quill.com are kind of our power 3 that we recommend for getting started. Getting started establishing those trade lines and getting those net 30 accounts is going to get enough information reported that the credit bureaus are going to start to pay attention to your credit report.
Okay, so let's think about that, because with interior design, many times, we're buying product for our clients on their behalf. Sometimes we have to pay up front to get the account established, and then we can go on net 30 terms. And so even building it with those companies is starting to build that credit. Is that the case?
Absolutely. Think of it this way. Like you had mentioned earlier while we were talking, you said you're getting these big credit card offers and you're just throwing them away because you don't need the credit. The same thing starts to happen with your business. If your business credit profile is set up properly, so your fundability is set up, you've got your address, everything is properly reporting in a way that's going to make it easy for banks and lenders to fund you. If that's set up right, and then you start establishing the payment history, you get 2-3 months in there of making payments with some of these smaller ones like Uline and Granger and Quill. Now you start getting instant approvals for tier 2 accounts. And it's just a building process because, again, your credit it's a risk factor. So
Sure.
You're showing, hey, I've got the ability to pay these accounts with no problems. Now, when you get into tier 2, you start getting into which for interior designs may not have a bunch of stuff, but you've got like United Rentals, Office Depot, Home Depot, which is very good. You get a lot of fleet credit cards like Quick Trip and Valvoline. Lowe's is another great one. That's when you start getting into more of the retail shops. Now, a lot of them are still going to offer you the net 30 accounts, but those are going to be the ones that as you start to establish the relationship with those net 30, it can very quickly turn into a net 60, or it can even get to the point where it starts automatically jumping up to tier 3 and you start getting offered actual lines of credit.
Okay. Yeah, I've seen some of those in tier 2. I mean, it could be sometimes net 30, net 60, net 90, just based on what it is, but certainly longer terms where I know many of us had to start even before we could get net 30. We had to start with just finding somebody to give us a business credit. I remember getting the first business credit card, right? That was not under Michele, that was under Scarlet Thread. And after time of paying off the credit card, when you go set up with new vendors, they are asking you about your credit history. They're asking you to tell them 3 other vendors that you've worked with and what your payment terms are with them. And they're using that information. And then I remember moving up and thinking, I have arrived. They're not making me pay for 30 days and I've already got it, right? So I can absolutely see how that progresses. The same thing happens, I think, again, Keith, correct me if I am not understanding this correctly, but I know for many of the interior designers, they get that initial credit card, and let's say it has a limit of $5,000. Okay. And the more they pay and the more they buy and the more they keep paying it off, it moves up to $10,000. And then it moves up again when they can almost prove that they can keep it paid off and keep the credit moving so that it's more revolving. Then they keep getting more and more and more. And until that happens, many of the designers that I work with, they might have to pay that credit card every week to clear it out for the amount of product that they're bringing through at the beginning.
Mm-hmm. Yeah, and when you start getting into credit cards, function almost exactly the same way on the business side as they do the personal side. When you get into the credit cards, a relationship, as you start spending money, as they see that you're making your payments, you're paying it off, you're being responsible with how you're using it, they're going to increase your credit limits on it. Okay. Now, one of the things that I want to take you back to, though, is a conversation that we have a lot, is that when you first got started, you had to go out and you had to start looking and open up a credit card. Now, when we've actually seen the statistics on this, over half of the business loans that are applied for are automatically turned down due to the information that's being reported to the credit bureaus. And it's not information like payment history. It's information like your email address. So if you're out there and you're running a business with @gmail.com, @yahoo.com, that's immediately a fraud flag for a lender. If your address is a home address, that's immediately a fraud flag for a lender, and they're going to automatically turn you down for funding. So what we found is that as we go through and as you properly set up your business, you see, I keep going back to that because it's one of the big keys to all of this is making sure that your business is properly set up. As your fundability goes up, the ability to get approved it amplifies significantly, because the thing is that banks and lenders are smart enough to look at the big picture and know that loaning money to a business is actually a little less risky than loaning it to an individual, because a business has the ability to turn around and make money. They have the ability to have a really good month and be able to pay everything off. So the risk level is actually a little bit less. And then you start getting into net 30 accounts where they're limiting their exposure. But getting approved for those, once you have everything in order and once everything's lined up properly, getting approved for those net 30 accounts is very simple. And then from there, it starts to kind of snowball once you get the payment history. It's not the problem, but what most people miss is just the proper preparation up front. Because if you set up right, then the results later on down the road, 3 months, 6 months down the road, is significantly better and faster if you're taking the proper steps up front.
That is a really, really, really good point. We've had other podcasts where we talk about establishing a business and making sure that we're setting it up properly. This is a good part of it. Already be thinking about, which is kind of hard for some of us when we're first starting, but to think about later funding needs or fundability or credit needs. And so of the 4 tiers, I think you said was
right.
The first is kind of we'll call it easy, quick, net 30 type of credit. The second tier was, like you said, I think you called it a fleet credit card, a little more of the retail, the Home Depot, the Lowe's, those kinds of things. The third was being offered a line of credit.
The third is advanced building. So tier 3 is when you start getting into more of the advanced credit cards. Starts to get a little more niche-y, I guess is a good way to put it, or niche, or however you want to pronounce it. But that's where you start getting into funding from Lowe's and different projects where they'll start loaning you money based on a project, or they'll start giving you revolving terms. And the way that I like to put it, I like to make the analogy of it being in a relationship. Once you're getting to tier 3, you're in a very committed relationship with this company at this point. Now you're not exclusive, but you're committed to them. They're making payments. They start listening to your needs and what you're looking for, and they start working with you on it. And so you can have net 20s and it can get revolving, or you can get net 60, net 90. And that's the lenders will walk you through that as you start progressing. So like you could start with a Lowe's account on a tier 2 and then advance it to tier 3 as the relationship grows, and then turn it into just a full-blown line of credit as it progresses from there. Now, the difference, this is where most people right now are going, well, I could just go out to Lowe's and I can get a credit card on my own because I got good credit. Absolutely. We're trying to get you a credit card for Lowe's that's not tied to your personal credit.
Right.
So
Tied to the
goal
business
of
only.
Right. That's why we're going through these steps. That's why we're building this relationship with the bank, is because we're doing it just under the company name and getting to that point that Lowe's is going to look at the entity, the company itself, and loan money to the company, not the individual.
Okay, so before I ask my next question, what is tier 4?
Tier 4 is it's really big accounts. That's the best way. It's revolving accounts. It's not the top of lending, it's the top of credit. So this is where you've got your prime credit. This is where banks are going to start offering you lines of credit. This is what you would refer to in personal lending as A-paper loans and A-paper lending. This is going to be your prime credit cards. This is where you start getting into commercial vehicle financing, equipment financing from here. Apple is one of the vendors that are on here. So this is where you start getting into some of the big accounts that show a lot of credibility within your company, but also very flexible on your net accounts. I mean, they have a lot of different options for that and revolving as well.
Okay, so what are then the benefits of getting credit based solely on the company entity and not having it tied to our personal credit or having some personal guarantee on it?
I'll be transparent with you for a little bit, because this is why I'm so passionate about this, and this is why I do this. I had a company that had failed because I made a critical error in my accounting with contractors versus employees. The state came in, found it. They charged me a lot of money, and I didn't have access to the credit that I needed to pull myself out of it, and I lost my company from it.
Yeah.
So right
How
there.
many good reminders in that one statement, right?
Yeah.
Put your people in the right place.
Put your people in the right place. Make sure that you're working with an accountant who knows what they're doing. I mean, there's a lot of stuff that goes into that. That's really what drove me to the business funding side, is because looking at it, now I realize I could have avoided it if I would have been focused on setting up my company properly and having it funded through just the business and just the EIN number. And so what it does is one, as a small startup, it gives you access to capital, which is just huge. I mean, it just, those lines of credit, those net 30 accounts are just going to give you room to breathe, to function, to not feel like you're on a constant cash crunch all the time. The second thing is it's going to add a level of protection for you. So as your business credit starts to grow and as you can separate the personal from the business, it's going to give you that peace of mind of knowing that no matter what happens to you, you're protected. So if the company, God forbid, something happens and you can't function, you're still personally protected. Nobody's going to be coming after your personal assets. And the other side of it is it offers for long-term growth, because at the end of the day, a great analogy that we like to use is, do you think Walmart is actually using their own cash to buy their products? They're using lines of credit to be able to purchase products and resell them and then pay off those lines of credit with the cash that they get from sales. That's how big corporations are functioning. They're using their business credit to leverage their purchases and to make sure that their cash flow maintains to a point that if they have downturns, if there's a dip in sales, the market crashes, COVID happens, whatever happens, their cash flow can remain consistent and can be steady and is not just tied to instant purchases of things. And so it gives you that ability for long-term cash flow projections, for long-term growth, for looking at the big picture of your company so that you can successfully navigate it instead of it having to always be dependent on instantly where you're at on a cash cycle right then and there.
Yeah, you see a lot of it happening for inventory replenishment.
Right.
So let me ask you this. We've talked about setting up your business correctly. What are the entity structures when we're setting up our business that are the best to help us? I would personally think that if we're really trying to separate, setting up just a DBA with our name is probably not going to be the most effective long term.
Yes, absolutely. The best way to put it, as soon as any time that you're using your name or your social security number for a business, you're not protected. And you're not going to be able to set up business credit that way because the entity itself is tied to your social security number. So anything, we like to say LLC or better.
Yep.
So
that's what I was thinking. LLC, S Corp, C Corp, partnership, something, but just not sole proprietor.
Just not sole proprietorship. Absolutely. Yeah, because the sole proprietorship puts you in that place where you're not really.
Well, you and your business are commingled at that point.
Right.
just
Absolutely.
by
Yeah. The two
name,
are
right?
inseparable.
By entity. Yeah. That's a good point is to, when we're really thinking about credit and we're really thinking about funding and we're thinking, again, talk to your lawyer, talk to your accountant. It can be different for each person how you make these decisions. This is informational purposes only. However, and I know that from my experience being an LLC, I needed the layer of protection for our own retirement and for everything else. And I wanted the entity of Scarlet Thread to be different than Michele Williams. And that was the first step to do that before I then moved to S Corp and other things. But so that just a good reminder to look at your own situation. And here's the good thing. Even if you're a sole proprietor and you think I want to grow my business, change my business, have the opportunity to have business credit and business funding separate from personal, you can still go become an LLC. I mean, you can change your business entity. Mine has changed over the years. And so it is possible to do that. There are rules around it, but it is possible to do that. How long does it take? I know you said that they're really under business credit looking at your payment history. They're looking at a 12-month rolling time frame, but how long does it really take to build business credit?
About 30 days.
That's pretty
Yeah.
quick.
Yeah, very quick. Yeah, because again, once your infrastructure is set right, once your fundability is intact and everything's there, getting approved for those net 30 accounts is very quick and easy. Those are the ones they like everybody. They'll get out there, they'll take a risk. It's small because it's limited exposure. Getting approved for the net 30 accounts is pretty simple. To get to the point where you're starting to look at tier 3 and tier 4, that's usually a 6 to 9 month process.
Okay. So we talked about like wanting to have business credit separated from our personal, just so that we could have the credit based on the business entity by itself. If we are the owner of the company, does the business credit have any impact on our personal credit? Are they tied together at any point?
That's a great question. And the answer is yes. And the reason is because your business credit, when you're starting it out, it's kind of like a child, 18-year-old just getting ready to, or just graduating high school, just getting ready to go out in the world. They don't have anything. They don't have any reputation. They don't have any credibility. There's no proof of anything. So basically what you're doing as the business owner, as the parent of the business, is you're stepping in and saying, hey, I'm going to co-sign for you for a little bit. So as you get started within first 6 to 9 months, there may be some accounts that you're going to need to put a personal guarantee on. We always strive to help people to not have to do that, but very often we see that it could streamline the process to put a personal guarantee on some accounts. And a lot of times you find business owners who are in a little bit of a cash crunch, who are needing to get those lines of credit, that having a personal guarantee on a credit card could jumpstart them, get them some credit quick, and then give them that ability to breathe and have that flexibility of being able to go back and take the previous steps before with like the net 30 accounts and tier 2 accounts, tier 3 accounts.
Okay. All right. So we're going in and we're creating this credit and we're looking at our reports. You've told me we can get our reports through credit monitoring. We'll have a link for that. Who else can see our credit report? Who else is looking at it?
Everybody. Business credit is a little bit different than personal credit. You don't need that much information to actually access the credit reports. But because business is more public, it's going to look at, can actually see who's got business credit, but you have to have subscriptions. So basically it's lenders. And again, credit was made for banks. It was made for lenders. It was made for people who are giving money out. And so anybody who's looking at your credit to be able to approve you, and this could be like if you're trying to lease a property, it could be, when you get into any sort of loan, so any of your net 30 accounts, even SBA, stuff like that, they're going to be taking a look at what's going on with your credit report. But you can see public views that people can see if you actually have credit established for your business out there.
So the lenders that are looking at it, these banks and businesses that are looking at it, are they just looking for the score? Are they looking for more information? What is it that they're actually looking for when they look at that report?
When I say banks and lenders, there's other people who are going to be looking at it as when you start looking at the marketing side. We're going to take a step back from the main question to help set up the answer for you.
Okay.
The way that credit bureaus make their money is they make a little bit of money by selling the reports to businesses and the banks. But where they make the bulk of their money is selling data. That's why credit bureaus are so big and so powerful, is because they're aggregating all this data for basically every business across the United States. And so they're data brokers. And when somebody wants to market to a business, they're going to go in and they're going to buy a list. The credit score doesn't play into that until you start getting onto the lending side and getting approval for lendings. But the credit bureaus are going to sell the information to anybody who's interested. So basically, you could be Comcast and going out and saying, hey, I want to market to every business in this area that has these certain criterias. And you'll buy that list, and then you'll go out and you'll market to that list. And that's how they make the majority of their money. So those people are going to be looking at it. Those aren't hard credit pulls. Those are soft pulls. That has no impact on your scores whatsoever. It's just for marketing and promotional purposes. Bank looking at it from an approval standpoint. So they're the ones who are going to be buying your Paydex score. They're going to be looking to say, okay, what's the risk factor on this borrower actually look like? So they're going to be making money from the lenders, and the lenders are going to have access. They're going to be looking at it. The one thing to keep in mind is just like on personal, people often get confused because they think that their FICO score and their credit reports are the same thing. They're two completely different entities, and they're ran by two different companies. So FICO runs your credit score on the personal side, where the credit bureaus actually have the data for what's going to calculate that score. On the business side, the bureaus are going to have that information. They're going to sell that data, and then the lender is going to pay Paydex to calculate that score. Who's looking at your credit reports? Anybody that you're trying to get a loan from, and anybody who's interested in marketing to you. That's really who's going to be the majority of the people who are going to be looking at your credit reports.
All right, and so you mentioned a soft pull and a hard pull. The soft pull you said was for marketing. That means it's not affecting the score or anything. It's just pulling of the information. Describe what a hard pull is, because I'm assuming that might be kind of like on the personal side. If you had, let's say you tried to put in a loan 10 places, it's going to show up that you are like really in need of money if you're applying to 10 different places.
Right. Yeah. Basically, it's an inquiry. And so the reason that inquiries are so impactful when you're looking at any sort of credit reporting is because it's an indicator. And it's an indicator that somebody is out there aggressively and actively looking for money. The way I'd like to put it is, if somebody came to you, somebody that you know pretty well, and they said, Michele, look, I want to borrow $1,000. And you knew them, they consistently borrowed money from you before, they paid it back, you knew they had a great job and they could pay it back, it wouldn't be an issue. You may not think twice about it. If you hear that same person ask 10 other people around you for $1,000, your reluctancy is going to go way up, because now you're like, well, why are they asking so many people? And if I give them 1,000, are these other people giving them 1,000, and do they have the ability to repay me? And that's why the inquiry process is so important, because when they see that that somebody's looking for money, it changes their risk factor.
Sure.
Because when it takes 30, 60 to 90 days for an account to get reported on the credit bureau, and that's after you've used the money. If somebody's out there getting a lot of credit really fast and it's not showing, it can have an adverse effect on Paydex score. But again, once you make those payments, and it's based on 12 months, and so once you start making those payments quick, scores recover very, very rapidly.
Can you put a lock on your business credit? I know we have one on our personal credit. After all of that, we lock it down. For example, when I needed to buy a car last year, I had to call, unlock my credit, let them run it, and then I relocked my credit. Is it possible to do that on the business side?
Yeah, absolutely. It functions the same way, and it's actually ran. 2 of the 3 bureaus are the same as your personal tax experience, because there's still fraud that can happen on the business credit side as well.
Okay, just curious how that worked. Given that we started off by me telling you I had not even checked into my business credit.
No, that's a great question. Nobody's actually asked me that question before, so that was a good one.
Yeah, I mean, even when our son went to buy his house, we locked everybody's credit when we had some of the breaches, because one of our family names were on the list, and so we went through and made sure everything got locked down, and we have watches on it. We get reports on it so that we can make sure that nothing happens. And so I just thought, I haven't done that to my business. I wonder if it's even an option. Mm-hmm. Oh gosh, there's so many things. You got my head spinning now. If somebody were trying to start right now from the very beginning, let's take a couple of scenarios, Keith. The first is, they're brand new. They have their company set up at a minimum as an LLC so that they can separate out. I'm assuming when we talked about the tiers, one of the first things they can do to start building that business credit is to work on getting that first easy, quick credit. Is that the case?
Yes, that is the case. And before you jump into lending, because everybody wants to jump into lending, because honestly, you don't care about credit until it's tied to money. That's the reason we're doing this, is to get approved for credit. But the first thing they can do is make sure that they've got a business email address, that they've got a website, that they've got a business address that's not tied to a residential property. Again, taking those steps to get fundable is going to be the number one key and is going to eliminate just years and years of frustration. I've talked to people that are like, I tried this. After I even looked at tier one, because I couldn't get approved for anything. And we go in, we change a couple things. A month or two later, they're getting instant approvals for tier one and tier two because of the age of their business. So once you've got all that set up, the first thing to do, absolutely, like I said, are three that we recommend. Uline is it's good. Granger is good. Quill.com is good. And the one thing that needs to happen with those, you can't just have the credit line. You actually have to use them.
Yeah.
So
that you build the credit history.
Right, exactly. If you don't have a payment history, there's nothing for it to report.
Right. I work out of my home. So my business address is my home. Now, I personally, I don't even know if I'm a 1, 2, 3, or 4. I do know that I'm getting 6-figure offers for lines of credits from my bank that I shred. So I'm assuming that it's pretty good. But they know I work from home. My articles of incorporation have my home address on them. Is that really the stickler? I mean, do I need to go, some of my listeners, are you talking about going to just get a P.O. box? What is it? Because they are working from home. I have everything else you said. I got a website. I got the business email.
Right.
I got everything else. I got the EIN. I got the S Corp. Got the articles of incorporation. I got it all. I just work from an office in my home.
This is really where the popularity of like Regis has come in. That's the reason that companies like that are being so successful right now, is because they're setting up legitimate business addresses that they don't actually have to work from. If you set up a PO box, there's notifications inside of that lets lenders know this is a PO box. Yeah, the UPS store is the same way, where they've got notifications that notify lenders that this is a box inside of the store. Where you start getting into Regis, you start getting into a couple others, and we'll put a link in the notes for you, some of the different places that offer it, that good ones. Having that business address makes a big difference. And that is something that we're keeping an eye on. Not that it is changing, but we believe that with everything going on, that has the possibility of changing.
Right, exactly, because so many people are going to potentially come back to work from home again.
Right. But one of the things that I want to bring to your attention is when you were talking about, getting the big credit offers, you also started with your personal credit attached to it. When you start getting those big lines of credit, if you don't have your personal name attached to them, that's where they're going to want to see the credibility of the business itself, self-sustaining, not on your personal address.
I mean, I'm definitely getting mine on business account. I haven't dug into it, Keith. Clearly,
right.
I need to go.
Right.
What type of businesses should have business credit? Should all businesses have it, or
any business that wants to protect themselves? So yes, absolutely, because every business out there will have some sort of business credit profile. And the thing about credit is nobody cares about credit until they need it.
Right.
Whether it's personal, whether it's business, nobody's thinking about it until, oh my gosh, COVID hit. What am I going to do? Oh my goodness, Godzilla's attacked the city. What am I going to do from here? And so what we're trying to do is educate people. Look, get out there, get your business credit profile up to date. Start establishing these smaller lines of credit. Get out there and build your credit profile, so that when you do need the big trade lines, if something happens, if you find a company that you want to buy out, if you want to buy a property, you want to buy equipment, you want to finance it instead of using your cash, you've got the credit available. So, people that tell everybody, look, if you've got a business, you should be paying attention to your business credit, because there is going to become a point in time that you're going to want it. Right. You're going to need it at some point. And having that option of not having it tied to your personal Social Security number, one, is just a huge relief, but it builds the value of the business as well.
On the personal side again as well, our son was going to buy his first house. We knew at some point that he was going to do that, right? But all the way back in college, we tied our personal to his, put him on our credit card, family credit card, and let him start building up credit. And my husband and I have great credit scores, so he was right in there with us. Then when he went to buy a house, it was transferred to him. We ended up taking our names off, leaving him on it, and that gave him the credit to then go buy a house. But it took him a couple of years of being on our credit card and him paying his part and us paying our part for him to start building up that credit. Like he couldn't just walk in one day, open up a credit card and turn around and have no other credit line, then go in and buy a house. You're gonna look at you kind of weird.
Yeah.
So it's the same kind of thing in the business. You're creating this credit history before you actually need it, because when you need it, you need to have already done it and had it.
Absolutely. That is one of the best ways to explain it. Don't even have anything to say after that. You took my line.
That's okay. All right, so let me ask this. So now that we've worked on our credit and let's say we have a decent credit score, what is it that we need as a business owner to qualify for a loan or a line of credit?
Great question. So when it comes to start getting approved for funding, we like to call it the 3 C's. And the 3 C's mean you have cash, credit, or collateral. And what lenders are looking for is your A lenders, your SBA, your big banks, the ones that are going to give you the great rates, great terms. They're going to be analyzing those cash flow, business credit, and then they're going to be looking at your collateral. You have assets, you have equipment, you have property, what is assets that you have. Those are the 3 qualifiers for business getting approved for funding.
Okay, cash, credit, and collateral. Okay, perfect.
If you have the 3 C's, you become, banks love you. They want to give you money. Now, when you get into business lending, business funding, business loans, it starts to take a bit of a turn here because, like on the personal side, things are pretty tight. I mean, since the mortgage meltdown several years ago, lending on big loans for personal has really tightened up. But on business, you still have a lot of alternative lending sources. So you could be looking at like merchant advance, where if you don't have 1 or 2 of the C's, if you've got any one of the C's, there's funding out there that can accommodate you. So let's say you've got cash, but you haven't built your business credit, you don't have collateral, you have like merchant advance loans, you've got revenue loans, things like that will look at the cash flow of the business and approve you based off cash flow, or even just the money that you have running into bank accounts. Let's say you have credit. If you have credit, you can start looking at stated loans. You can look at loans that are going to be tied, lines of credit that are just tied off of your payment history and what you've made. If you have collateral, same thing. If you get, let's say somebody's got a property and they're trying to get approved for funding. If they've got a property that's cash flowing, but they don't have the collateral or the cash, you can get approved for funding based off that. So if you have one of the C's, you can get approved. If you want the best, if you want prime rates, if you want to maximize what you're doing with lending, you need to have all 3 of the C's.
Now, how does all of that tie in to profitability in a company? All about the profitability and how we're making our money. So does a company need to show that they have positive net profits? How does that work? Do they even look at that?
Great question. They look at it. It's not the end all be all determining factor, because one of the things that I've mentioned a couple times is cash flow. They're looking at what the business is doing from a cash flow perspective. And the reason they're doing that is because at the end of the day, profitability is a movable number, I think is a way to put it. Like owner distributions, you've got appreciation, you've got a lot of different things that go into what's impacting the actual profit of the company. Where when you're looking at cash flow, that's looking at it from a 12-month standpoint of going, okay, you consistently have this revenue. Can you afford to pay back this loan based on the revenue, or the cash that you have coming into your business? So profitability will play into it, but it kind of plays a backseat to what cash flow does for funding.
Okay. So if somebody's thinking, I'm thinking about getting a loan because I want to expand my business, I want to buy more inventory, some of these things where cash flow is an issue. They've got cash, but they don't have enough current cash to do what they need to do, and they're going to need a loan. Where do they start? How do they choose which lenders to go talk to?
So what I always start with is, the first thing I always do is looking at your business credit. And just bringing it back full circle for us, because starting at that place is a great place to look at it and be able to figure out, where are you at? How does your credit look? Is this something that's going to make sense? But then from there, it's sitting down and figuring out exactly what you're going to do, and then exploring the options. We do a lot of funding for clients, but I always recommend get out and talk to some local banks as well. Get out and start talking to different businesses about the funding, because funding is one of those things that sometimes can be a little hidden when it comes to the business side. Because if somebody just jumps online and they're like, I'm going to Google how to get a business loan, you're going to get the best marketers, not necessarily the best products. So you may get a lot of merchant advances, you may get a lot of accounts that are going to be stated, So the first thing is to figure out what exactly do you need it for, look at it, and then figure out what terms that you are going to need. And then the best thing to do is start talking to brokers, start talking to bankers and looking at it. Or if they want, there's a link in the notes here that they can talk to us about their funding options to see what makes sense for them there.
Is it better to get a line of credit before you need it or go after it when you need it? How much in advance do we need to be thinking about getting lines of credit?
Right now. And the reason is, very honestly, Michele, did you see us going through a lockdown 4 months ago?
No, and like I said at the beginning of the podcast, I always encourage my clients to do the same thing that we do with our home. We've heard for years, 3 months of savings, 3 months of savings. And my businesses, I've encouraged them based on the size of their business, 3 to 6 months, 3 to 6 months.
Right.
But we're literally running through the 3 to 6 months and not in some ways able to replenish those funds quickly.
Mm-hmm.
That's the problem. It's not the first 3 to 6 months, it's the second 3 to 6 months.
Right. And that's where having a good line of credit is going to help just smooth that out for you, where you may have 3 to 6 months of just hard operating costs of being able to look at it and say, okay, I can provide 3 months if I just pay everything out of the bank account. That changes a lot when you look at it and you go, I can pay 3 months out of my line of credit, and then I can float that another 3 months because I can pay it back. And so now you're looking at 6 months. So now your spike of what your cash flow looks like is starting to go way down, and you're able to make bigger moves. You're able to add some more stability. So lines of credit are great because you have them when you need them. They're not something that you have to pay on all the time. It's not like an installment loan where you're going to go out there and you're going to have this monthly payment that you're going to pay. It's there. It's available cash when you need it. So when you get into these situations, you're not left just hoping the government gives you money or that's something that you're able to make it work. You've got a backup plan there to help you through it.
Yeah, and just a reminder to the listeners, we're talking about conscientious lending here. We're not talking about going out and getting a line of credit or getting loans that we know full well we cannot pay back. Like, that's just bad business. So
that is a very great point. Yes, yeah, absolutely.
This is meant to tide us over. This is meant to get us through, but we need to know that loans have to be repaid. This is not like some of the things that we are getting right now with PPP and those loans. That is way outside of the box. We're talking about more traditional lending, and that needs to be taken with a plan, conscientiously, knowing that we have the ability to pay it back.
Mm-hmm. And I always recommend to clients, if you're looking at a loan, talk with your CPA, talk with your accountant, make sure that it's something that fits into your business model and it makes sense. It's something that's sustainable for what you're doing. Because exactly what you said, it's a loan, and terms and conditions that have to be complied to.
Right, and there are repercussions of not paying it.
Mm-hmm.
So the goal here is not to fund an unhealthy business, but to fund a healthy business. Wow, Keith, we've covered so much. Is there anything that you'd like to leave with our listeners as we wrap up? I mean, we've gone from credits to lending to how to start it, how to get through it, how to monitor it. What else, as we wrap up, do you think we absolutely need to know?
There is so much on this, Michele. This is a very big topic. It's very deep. There's a lot of stuff that goes into it. In the links in the notes, we've actually got a link that they can download a free guide on how to establish the first steps that anybody can take to set up their business properly and to start establishing credit in their EIN without their Social Security number. Credit Suite gives away a lot of information. We're constantly just giving away free guides, free workbooks, anything that we can give people to be able to help, because again, we're passionate about it and we know that this is how you bring stability and health to a company, is by making sure that it's fundable, so when you can have access to money when you need it.
That sounds fantastic. Keith, thank you so much for your time today, and thank you for such a great conversation. And I guess now you've added to my to-do list, but that's okay. I needed to do it anyway.
Well, thanks for having me on, Michele. It's been a pleasure talking with you.
Same to you. Have a great day. Wow, I learned something new on this episode, and I sure hope you did as well. Being conscious of our credit history and score is important, and you can bet I'm going to be digging into mine more now that I know more. While helping you understand the finer details of your business credit is not my superpower, helping you run a successful business to know how to use the funds you get certainly is. If you're in need of assistance to manage your business and funds, reach out and let's talk. I would love to support you in either the Designer's Inner Circle or in my Elite Coaching Program, both using the AIM with Intent methodology. You can get more information at scarletthreadconsulting.com. And always remember, profit doesn't happen by accident.